Imagine walking into work on Monday morning and making $50 million before lunch. Now imagine losing $50 million before lunch. Same office. Same employees. Same strategy. Same day. That's the hedge fund business. Most companies make money by selling products. Hedge funds make money by being right. And sometimes by being less wrong than everyone else. Which creates one of the strangest economic models ever built. A business where a bad year can erase billions. A good year can create billionaires. And the actual product being sold is neither stocks nor bonds. It's confidence. By the end of this video, you'll know exactly how hedge fund empires make money, why managing other people's money is often more profitable than investing your own, and how a handful of fund managers built fortunes larger than many national GDPs. Let's start with the entry fee. Because contrary to popular belief, starting a hedge fund is relatively cheap. Building a successful hedge fund is not. A basic fund structure can be established for a few $100,000. Legal work. Compliance systems. Auditors. Technology. Operations. Prime brokerage relationships. Office infrastructure. Expensive. But manageable. That's the surprising part. The real challenge isn't opening the fund. It's convincing wealthy people to trust you with money. Imagine opening a restaurant. Now imagine customers must deposit $10 million before seeing the menu. That's closer to reality. Institutional investors rarely care about your intelligence. They care about your track record. Pension funds. Endowments. Family offices. Insurance companies. Sovereign wealth funds. All of them ask the same question. Why should we trust you? And that's where most hedge funds die. Not from bad investments. From lack of credibility. A new manager might spend years raising their first $100 million. A proven manager can raise $10 billion in months. The difference isn't skill. It's reputation. Which means the real startup cost isn't money. It's trust. Then scale enters the picture. A small hedge fund might manage $100 million. A respectable fund might manage $5 billion. The giants operate in a different universe. Some firms manage over $50 billion. Others exceed $100 billion. At that point, you're no longer managing investments. You're managing financial ecosystems. Entire departments. Researchers. Economists. Quantitative analysts. Software engineers. Risk managers. Lawyers. Traders. Data scientists. Compliance teams. Thousands of employees. The public imagines a trader staring at screens. The reality often resembles a multinational corporation. The summary is simple. Starting a hedge fund is affordable. Building an empire is expensive. Now let's look at how the money actually works. Imagine a gym membership. The gym earns money whether you become healthier or not. It collects monthly fees simply for managing access. Then imagine the gym receives a bonus every time customers lose weight. That's essentially the hedge fund model. The industry term is 2 and 20. Historically, many hedge funds charge 2% management fees and 20% performance fees. The exact numbers vary today. The principle remains. Let's simplify it. Suppose investors give you $10 billion. You charge a 2% management fee. That's $200 million annually. Before making a single profitable trade. Think about that. You could theoretically have a mediocre year and still generate enormous revenue. Then comes the performance fee. Let's say your fund gains 10%. That's $1 billion in profits for investors. A 20% performance fee produces $200 million for the manager. Now combine the two. Management fees. Performance fees. Suddenly 1 year generates $400 million in revenue. And that's on a relatively modest institutional scale. The largest funds operate with much larger numbers. This creates a fascinating business model. A restaurant must sell more meals. A manufacturer must produce more goods. A hedge fund often grows simply by attracting more assets. More assets create more fees. More fees create more resources. More resources can improve performance, which attracts more assets. The cycle feeds itself. The public thinks hedge funds sell returns. The business often sells access. That's an important distinction. Now for the hidden layer. Because this is where the real economics live. Most people think hedge funds compete through investment skill. They do. But not primarily. The casual observer sees stock picks. The fund sees asset gathering. Consider this. A manager overseeing $50 billion at a 1.5% management fee earns $750 million annually before performance incentives. That's extraordinary. Even if performance is merely acceptable. This changes incentives. The greatest hedge fund businesses are often not merely investment machines. They're distribution machines. Relationships become assets. Institutional credibility becomes an asset. Brand reputation becomes an asset. Access becomes an asset. A billionaire investor with strong returns but weak fundraising skills may remain relatively small. A respected institution with decent returns and elite relationships can become enormous. That sounds unfair. Markets don't care. Capital flows where investors feel comfortable. Now let's talk about why smart people still fail. Because hedge funds are graveyards full of intelligent people. Failure pattern number 1. Confusing intelligence with risk management. Being right isn't enough. You must survive being wrong. One of the most famous examples was long-term capital management. The fund employed legendary traders and Nobel Prize-winning economists. Its models appeared brilliant. Its confidence was immense. At its peak, the fund controlled positions worth over $100 billion while using extraordinary leverage. Then market conditions changed. Losses accelerated. The firm collapsed. A rescue organized by major financial institutions became necessary. The epitaph. Managed over $100 billion. Nearly destabilized global markets. Intelligence without humility becomes leverage. Leverage eventually collects payment. Failure pattern number 2. Growing faster than the strategy. Many investment approaches work beautifully at small scale, then collapse under size. A strategy earning exceptional returns on $500 million may struggle with $50 billion. Liquidity disappears. Flexibility disappears. Opportunities shrink. One famous example involved Tiger Management. The fund became one of the most respected investment organizations in finance. Assets surged. Market conditions shifted during the technology boom. Performance suffered. Investor withdrawals accelerated. The fund eventually closed in 2000. The epitaph. Managed billions. Closed at the peak of its reputation. Success can become a liability. Especially when scale changes the game. The summary is straightforward. The biggest threat to many hedge funds is often their own growth. Now for the payoff. Let's assume a smaller scenario. You operate a successful hedge fund managing $1 billion. Management fees equal 1.5%. Performance fees generate moderate additional revenue. Annual firm revenue might range between $20 million and $50 million depending on results. A highly profitable business. But hardly legendary. Now let's scale up. Imagine a fund empire managing $100 billion. Management fees alone could exceed $1 billion annually. Then add performance fees. In strong years, those fees can produce billions more. Suddenly the economics become extraordinary. A single investment firm can generate more revenue than major industrial companies. Without factories. Without inventories. Without supply chains. Without physical products. Just capital. That's why hedge fund economics are so unique. The product weighs nothing. Yet the revenue can rival multinational corporations. And because successful funds often invest their own money alongside client capital, owners benefit twice. They collect fees. Then they participate in investment gains. This is where fortunes become enormous. Which brings us to one of the great hedge fund titans, Ray Dalio. Through Bridgewater Associates, Dalio helped build one of the largest hedge fund organizations in history. The strategy wasn't simply investing. It was creating systems. Research systems. Decision-making systems. Risk management systems. Institutional systems. Bridgewater eventually managed well over $100 billion. At that scale, the company resembled an economic research institution as much as an investment firm. Dalio's net worth climbed into the tens of billions of dollars. Not because he picked a few winning stocks. Because he built an empire capable of managing enormous pools of capital. And that's the real lesson. The economics of running a hedge fund empire aren't primarily about investing. Investing is the visible activity. The real business is trust. It's distribution. It's reputation. It's gathering capital and deploying it efficiently. Most people imagine hedge fund managers making money by predicting markets. Sometimes they do. The greatest fortunes often come from building organizations that other people trust with their money. A manufacturer scales production. A retailer scales transactions. A hedge fund empire scales confidence. And confidence, when managed correctly, becomes one of the most profitable assets in the world. Because in the end, the most valuable thing inside a hedge fund isn't the stock portfolio. It's the willingness of thousands of investors to leave their money there tomorrow. And the day after that. And the day after that. Repeated across billions of dollars. For decades.